Everyone, and welcome. We hope you're all having a great day so far, and we want to thank you for joining us for today's webinar on the impacts of major events on the markets over time. My name is Nancy, and I'll be your moderator behind the scenes today. Before we dive into our presentation, I have a few housekeeping notes to mention. First, everyone on the line has been muted to limit disruptions. If you have questions, you're welcome to share them with us using that questions feature in your control panel. Today's webinar is being recorded, and you can expect a link to it to rewatch it and a link to the slide deck tomorrow in your email. Leaving the webinar, you'll be prompted to complete a very short survey. We'd love to hear your feedback and what you thought about today's presentation and any other topics that you have for us in the future. Today, I'm joined by Mark Hemby, who is a financial advisor with Saltmarsh Financial Advisors. He's a chartered financial analyst with over 15 years of experience in investment banking and institutional fixed income training and sales. We're also joined by Christina Doff. She is a shareholder in the investment advisory services practice and also the managing director of Saltmarsh Financial Advisors. She has over 30 years of wealth management experience, and she is filling in today for Chris, who has fallen sick. So thank you, Christina, for stepping in. At this time, I'm going to pass it right over to Mark to get you guys started.
All right. Well, thanks for the introduction, Nancy. I'm almost 50 years old. And since I've been a functioning adult, it seems like the world is always getting crazier. As a Gen Xer, most of my youth was defined by MTV and mostly a world of peace and prosperity. That all changed September 11th, 2001. And since then, it seems like we've had a cascading series of massive events. The housing bust, followed by the global financial crisis, a global pandemic, followed by a stock market crash that was then followed by a massive rally. Today, we're experiencing serious inflation for the first time in 40 years. And now, after almost 75 years, we have a war in Europe. As an investor, how should we react? Does this endless stream of negative news mean we should sell everything and put it under our mattress? To get some insight, let's look at how current circumstances compare with similar crises in the past. What are the immediate and then the long-term impacts on financial markets? Can we draw any meaningful conclusions? It seems like there's a lot happening all at once. And Christina, what are the most important events influencing markets currently?
Well, Mark, as you mentioned, we're going to examine 4 of the biggest challenges investors are facing today. They are rising inflation and potentially rising interest rates, black swan events, geopolitical events, and market corrections after a bull market. While no 2 events are ever the same, there's a lot we can learn from past challenges and highlight how investors should navigate them. So let's start with inflation.
That seems like a good place to start, Christina, because when we go to the grocery store, we're kind of reminded of it right now. We're experiencing the significant inflation for the first time since the early 1980s. Last month, the Consumer Price Index, or CPI, was reported at 7.9%. Now, the CPI is important because it's a major factor in setting future government expenditures like Social Security, as well as many other things. In a nutshell, the CPI is a measure of the price of a basket of goods and services. Now, how much the price of that basket changes on a year-over-year basis is the CPI number that you see get reported. For instance, last month, the price increased on an annualized rate of 7.9%, which means that the price of the basket in February of 2021 increased almost 8% to February of 2022. Now, besides this, why is inflation important? Well, imagine if your cash were an ice cube and you set that ice cube on a table. Inflation is the measure of the room temperature. The hotter the temperature, the quicker the ice cube melts. The Federal Reserve likes to target the room temperature at about 2%. Now, we won't get into why 2% is their target, but comparing it to the current rate of 7.9, it's a call to action for the Fed.
So, Mark, you defined inflation. Why does inflation matter? Or why does inflation happen?
What causes inflation is complex. The simplest explanation is that there are too many dollars chasing too few goods. Now, that's the classic economics textbook definition. Too many dollars chasing too few goods. Another factor that determines inflation is money velocity. Now that's a measure of how frequently the existing supply of money is spent. When you have an incentive to hurry up and spend your money because of the inflation, it can make the problem even worse.
So what can be done to fight inflation, Mark?
The primary responsibility for fighting inflation lies with the Central Bank of the United States, the Federal Reserve. One thing the Fed can do to fight inflation is to raise interest rates. Now, in reality, the Fed only controls a few interest rates. Most importantly, it controls the federal funds rate. Now, this rate is important because it influences all the other market rates in our economy, as well as rates worldwide. The bottom line here is the higher the interest rates, the greater the incentive it is for you to save your money instead of spending it. This acts to kind of slow the velocity of money, as well as it reduces the supply of money.
So what about previous episodes of inflation? What happened then, and how did the Fed react?
Now, a lot of analysts compare the current inflationary pressures of today with the 1970s. So for comparison, let's look at the following historical graph of CPI. As you can see, the current inflation is significant, historically speaking. However, it does appear that the 1970s were a lot worse. So what happened in the 1970s? Let's start with a brief history lesson. Towards the end of World War II, many of the world's most powerful countries agreed to make the US dollar the world's reserve currency. And in exchange, the United States agreed to exchange any of those dollars held by foreign governments for gold at a rate of $35 per ounce. Now, in the late 1960s, several countries, notably France and Great Britain, wanted to exchange some of those dollars for gold. Now, the reasons for that kind of outside the scope of this webinar. In any event, this depleted the U.S.'s gold reserves dramatically. And in fact, there was a risk that the U.S. could run out of gold. As a response, President Nixon ended the dollar's convertibility to gold on August 15, 1971, preventing foreign governments from redeeming their dollars for gold. At this time, the US dollar became a total fiat currency. Additionally, in 1973, OPEC countries enacted an oil embargo on the United States in retaliation for our support of Israel during the Yom Kippur War. Now, without unpacking an entire decade and analysis of why, these events and others helped push inflation to a modern high of 15% in 1980. The Federal Reserve's primary and original mandate is to maintain the stable value of the US dollar. This graph of excuse me just a second, lost my place. This is a graph of the federal funds rate from 1954 to 2022. Then Fed Chairman Paul Volcker made a bold and decisive move to tame inflation. Through a series of moves, he ultimately raised the Fed funds rate to 19%. Now, one result of this move was to trigger a steep and sudden recession in 1981 and 82. However, the economy did recover, and since that time, inflation has averaged less than 3% annually.
Until now. So how will the Fed respond, Mark, to the current episode of inflation?
Most expect the Fed to respond in a similar fashion. 2 weeks ago, the Fed's governors decided to raise the benchmark overnight funds rate to a quarter of a point, or 0.25%. The market now expects a 0.5% increase in the May meeting and further hikes for the rest of 2022.
So to Mark's point, in the 1970s, the S&P 500 returned 5.9% per year. The problem is inflation was over 7% per year, so that real returns were negative for the decade. The logical conclusion is that inflation must be bad for the stock market, right? Well, in the 1980s, inflation averaged 5.5% per year, but the stock market was up 17.3% on an annualized basis, nearly 12% higher after adjusting for inflation. So what about low inflation? Is that good for stocks? Well, inflation averaged just 1.8% per year in the 2010s, and stocks returned 13.4% on an annual basis. However, inflation was only 2.6% per year in the 2000s, yet the S&P 500 experienced a lost decade, falling 1% per year nominally. So all of this is to say we have no idea what the current inflationary environment is going to do to the stock market. Inflation is an inevitable risk when investing, but it's also the primary reason we invest in the first place. So what can you do to combat inflation? Historically, investors turn to equities to combat the long-term effects of inflation. However, stocks can be volatile. So if you have a short-term time horizon, leveraging high-quality bonds such as U.S. Treasuries are a good hedge. So this chart shows every year the U.S. stock market finished negative for the year, dating back to 1928. There have only been 4 years where both stocks and bonds finished down. In each of those years, bonds saw fewer losses. So let's move on to our second investor challenge. Mark, there are some other major events affecting markets at this time. What about the ongoing effects of COVID?
Yeah, I like to think of COVID as a black swan event. What is a black swan event? A black swan event is something that is unexpected and previously thought to be inconceivable. Additionally, it's generally thought of to have negative consequences. Now, you could argue that the COVID pandemic was not a black swan event because it was not unprecedented. But most people lump it in because it was so sudden, abrupt, and impactful. What made and continues to make COVID so significant is the scope of interconnectedness in our globalized economy. Previous pandemics, like the Spanish flu in 1918, happened when the world operated on a much more localized level. Today, just-in-time manufacturing works on an extraordinarily complex web of processes, and those processes depend on one another. And this creates multiple points of potential failure. These COVID supply chain problems are making this inflationary cycle worse because of the shortage of products. And I'm sure we've all had a product that we wanted to buy recently, or that we wanted to buy recently that we couldn't find, or it's been hard to find, or even back ordered.
Yeah, would agree. So 9/11 is a good example of an unexpected and highly impactful event. Wouldn't you agree, Mark?
I agree, Christina. And this is an event that most of us on the call are old enough to remember in detail. And like COVID, it was sudden and extremely impactful. Stock markets did not open on the morning of September 11, 2001. In fact, they remained closed until September the 17th. Now, that's the longest shutdown of the stock market since the Great Depression. Now, once stock markets did open again, the Dow Jones Industrial Average fell 7% on the first day. And for the first week after the tragedy, the Dow was down 14%. In total, $1.4 trillion worth of market cap and wealth was destroyed in the days and weeks following 9/11.
So unfortunately, it appears violence on a global scale is still with us. Can you speak to that?
Yeah, we have a hot war in Europe for the first time in 75 years. And part of the response by the US and NATO has been severe economic sanctions against Russia. These sanctions complicate the picture because of the amount of raw materials produced by these two countries. For instance, combined, Ukraine and Russia account for 30% of the world's wheat production. They account for 40% of the world's palladium production, 17% of nitrogen production. And that's just a few examples. These resources and many others are needed for various things like fertilizer and industrial applications such as batteries for electric vehicles or catalytic converters on regular gas vehicles. Now, while Russia and Ukraine, while their economies are not huge, their share of raw material production is significant. And this has made the global supply chain problems worse.
So Mark, with what is going on today, can you draw any comparisons to the past?
Well, hopefully, because of the way it ended, we can compare it with the Cuban Missile Crisis. The Cuban Missile Crisis happened in October of 1962. While the stock market was down in the first part of 1962, the Cuban Missile Crisis helped exacerbate that correction. And for those younger participants that don't remember it, the best summation of the Cuban Missile Crisis is we were extremely close to an all-out nuclear war with the Soviet Union. The U.S. had discovered that the Soviets had placed nuclear-capable missiles in Cuba only 90 miles from U.S. soil. President Kennedy was able to delicately resolve the conflict and avert direct military action. And to me, this is the most similar incident to the current situation in Ukraine, because like today, it was a confrontation between the two most powerful militaries on earth, the US and Russia. Additionally, we've had a market correction following these events.
So to that point, at the beginning of this year, we experienced a correction in the stock market. A market correction is defined by a decline of at least 10%. That happened this year, although the past few weeks have seen a reversal in that trend. To offer some perspective on this recent back and forth, let's talk about another time when we saw similar market declines after a long bull market run. So from March 2009 until January 2022, we had an almost 13-year bull market. Taking a look at the chart, that's a total return of over 540%. As I mentioned earlier, this year, the S&P 500 and the NASDAQ both dropped below 10% from their all-time highs. A similar event happened between 1986 and 2000. During that time, the total return of the S&P 500 was 526%. So what brought that party to an end? It was the dot-com bubble burst. I'm sure many of you remember that. We have no way of knowing what the future holds. Today's market declines might be as big as they were then, or simply just a bump in the road. But one thing is for sure, we've experienced down markets before, and we'll see them again.
Now this chart shows the ups and the downs for calendar year returns from 1979 to 2020. The blue bars represent calendar year returns. The skinny lines are the largest intra-year moves. Now notice during this period, most of the calendar year returns have been positive. But even in the best years, we've had declines. And even in the worst years, we've had gains. Now this is the noise and the volatility of the market. Now if you look at your screen and just kind of squint your eyes, so things are kind of out of focus, you kind of only can see the blue bars. And you would look at that and go, wow, you know, that's a lot of up years and not that many down years. And I think most of us would be happy with that result. It's those wild, skinny lines that keep us up at night.
I would agree. So what are the lessons? A market correction or any market decline is not enough of a reason to make a change in your portfolio. That should really be driven by your personal time horizon and risk tolerance. Wouldn't you agree, Mark?
I would agree. Now let's look at how equity markets performed in each of the previous events discussed. First, I want to explain this slide a little bit. The slide shows 4 bars in each of the events of the past, and each bar represents the total return during a certain time period. For instance, the light green bar shows the total return of the S&P 500 10 years after the initial event. So for instance, to start with the geopolitical event, in this case, the Cuban Missile Crisis. The stock market, as we had talked about, it had experienced weakness for the 11 months leading up to October of 1962. However, as scary as that was, look at the first hot pink bar. 1 year later, the S&P 500 was up 31%. And in fact, the total return of the S&P continued to be strong 3, 5, and even 10 years later. What about the inflation of the 1970s? In January of 82, as we discussed, Chairman Volcker raised the Fed funds rate to a modern high of 19% to combat inflation of 15%. Now, obviously, this was bad for bond markets in the short term, but what about equities? Now, remember, the rate increase helped create a deep recession in 81 and 82. So 1 year later, the S&P was down 7%. But as you look farther out in time, we see stocks perform extraordinarily well. In fact, the total return was a whopping increase of 165% 10 years later. Also remember that that 10-year time period included the 1987 stock market crash. So that 10-year return was overall pretty strong. Now the time period after 9/11 is a little more mixed. While the initial and 1 year aftermath were negative, the market had recovered nicely 5 years later in 2006. The total return of 28%, that's that blue bar. 10 years later in 2011, the total return was only positive 9%. Most of us remember that very lackluster performance during that 10-year period. The economy was roaring for a good portion of that time, evidenced by the housing boom. but it came to an abrupt end in 2007. The global financial crisis was the worst recession since the Great Depression. Now note, we discussed that bull market run that ended with the dot-com bust, and this 9/11 time period pretty much coincides with that time period as well.
So I'd like to pause here and ask our audience a question. How many of us are invested in a portfolio of 100% stocks? One of our tenets of investing at Saltmarsh Financial Advisors is appropriate asset allocation for a given investor's risk tolerance. There may be some younger investors whose time horizon and risk tolerance allow for a 100% stock portfolio. However, most of our clients are not invested 100% in stocks. Most clients have an asset allocation that includes bond funds or fixed income securities. In many ways, fixed income investments act as a ballast for a portfolio. When equity prices go down, we can rebalance to take advantage of lower prices. Mark, you want to talk a little bit more about this?
Yeah. Christina, let's look at this table. Now it's a little busy. There's a lot of numbers on there, but let's try to zero on just a few items. Now this table shows 6 different portfolios that have vary in their asset allocation. On the far left is a portfolio that's 100% fixed income or bonds, and on the far right is a portfolio that's 100% equities or stocks. And in between are portfolios made up of 20/80, 40/60, 60/40, and so on. So let's focus on the 100% equities portfolio for now. Okay, as you would expect, it has the highest long-term average return of 11.36%. Additionally, it has the worst 1-year and 3-year losses. 100% stock portfolio lost 47% from March 2008 to March 2009. By contrast, let's look at a more common 60/40 portfolio. This portfolio is 60% equities and 40% fixed income. Again, as you would expect, the long-term average return of 9.94% is less than the 100% equities portfolio. But most importantly, the worst 1- and 3-year periods are not as bad. The worst 1 year was down 31%. Now, this table is a great illustration of how asset allocation affects both risk and return. We sacrifice one for the other. Even though headlines might say the stock market crashed today, understand high quality fixed income investments like the ones we recommend can act as a shock absorber in a portfolio. The lesson is most of us have an asset allocation to bonds that cushion the blow of stock market loss. Most investors are not invested 100% in stocks.
So to get a broader view, let's look at how a $1 investment has performed over the past 50 years in a broadly diversified index. We've overlaid this on top of some significant news events that occurred during that time to see how the market was affected. While many of these events were newsworthy, they did very little to impact the long-term performance of the market. Markets have rewarded discipline. So Mark, what can a lack of discipline teach us?
Let's look at this right here, Christina. And I'll be honest, the first time I saw this data, I didn't believe it.
I agree with you on that.
Yeah. This analysis shows how if you invested $10,000 in 1990, how it would have performed over the next 30 years. Okay, now let's look at the first bar on the left. For the total period from 1990 to 2020, your $10,000 investment would have grown to about $20,000. But if you had been out of the market on the single best day, your portfolio would have had an ending value of $18,329. That's shown by the bar right there to the immediate right. Now, what if you had the unfortunate timing of missing the 25 best days in the market? You would have only, you would only have $4,376. That's just a little bit better than investing in treasuries. Now, scenarios like this are intentionally extreme, but it illustrates an important point. You have to stay in the market. Trying to time the market is a fool's errand. And if you're out of the market and you miss just a few of the best days, it can be a significant drag on your performance.
So let's drive this point home. Timing the market is incredibly difficult, if not impossible. Historically, there have only been a handful of people who have successfully managed to do this. That's because you have to be right twice. You have to be right about when to get out of the market and when to get back into the market. So discipline, as far as we're concerned, is really the best approach.
Great point, Christina. Now, if you're like me, in this era of the smartphone, it seems like we're all creatures of the moment. Events in a given day can seem huge at the time, but with the passage of time, many events are just a little blip. Now, Christina, do you remember any of these dates on the screen?
So honestly, Mark, no. If I had not helped to prepare this presentation, I would not be able to tell you what happened on those days.
Yeah. And I wonder if anyone in the audience remembers these dates, or what was the significant news that affected markets on these dates. So we're looking at September 29 of 08, May 6 of 2010, March 16 of 2020, and then this year, February 24th of 2022. And furthermore, do you remember how the market moved on these days? You may be surprised. On September 29th of 08, the S&P 500 dropped a whopping 8.8%. On May 6, 2010, the Dow Jones Industrial Average at one point during the day was down 998 points. In fact, it dropped 600 points in 5 minutes. On March 16, 2020, the Dow dropped nearly 13%, and that's the third largest percentage drop in history. And finally, and most recently, does anybody remember February 24th of 2022? That's just a little over a month ago. And on that day, the NASDAQ rallied. It went up in price, an incredible 7% in one day. Well, what happened on these days? First, on September 29th, 08, the initial bank bailout, everybody remembers TARP, had failed in Congress. Now, it passed a few days later, but do you remember this particular day? You know, there were a lot of bad doom and gloom days in the fall of 08. I remember them. But there were so many, it's hard to remember them all specifically, especially this day. Does anybody remember the so-called flash crash? I mean, I do, because I was only because I was working in financial markets and I was staring at screens all day. And that day, the market hit an air pocket and dropped instantly. You know, some people speculated that it was another terrorist attack. In that kind of situation, the crash itself becomes the news. Now, in reality, what happened was somebody on Wall Street and put a sell number with too many zeros behind it, accidentally. Now, this triggered algorithms within computer trading systems to panic sell. Amazingly, the market made a full recovery by the end of the day, but for a short time, it was a pretty big panic. Now, March 16 of 2020, now this is a date most of us could guess what happened, and this was the first Monday of the shutdown from COVID. Most of us were thinking about a lot of serious things that day, but the stock market was probably not one of them. As a reminder, if you remember 2020, the stock market actually finished the year up 18% for the year. Now, finally, on February 24th of this year, what happened? That was the start of the Russia-Ukraine war. Now, that would seem like really bad news for stocks, but instead, the NASDAQ was up 7% on that day. This last data point is important because you look at that and you say, well, this seems like a clear negative sell signal, but actually, it had the opposite effect. And 7%, sometimes that's a pretty decent year in stocks for a whole year, and it's a really great one day.
Yeah, that is very true, Mark. So the lesson here is many times daily moves or even intraday moves can be extreme. This is the market processing new information. This is volatility and risk in the market. But remember, without risk, there's no chance for reward. So we have to ignore the daily moves. So Mark, just to recap, what are the takeaways and lessons we learned today?
First, sudden market movements should not impact your investment strategy. Build a portfolio taking into consideration your personal goals, your investment time horizon, and your risk tolerance. Changes in your strategy should only be considered when one of these three considerations has fundamentally changed.
And number two, diversify your investments. Many of you have heard us preach that the number one driver of your investment return is your asset allocation, or what percentage of your portfolio is invested in stocks and what percent is in bonds. This is also the number one driver of volatility. We generally don't recommend you invest in 100% stocks. However, stock market returns get most of the media coverage and attention. And number three, discipline rewards long-term investors. Creating a plan that fits your financial needs as well as your risk tolerance is the first step. The next step is sticking to your plan. This is where working with a financial advisor can be incredibly valuable as we help to take the emotions out of investing. While it is sometimes not easy, history shows that staying the course rewards investors.
Fourth, market timing is futile. As we've seen, missing just a few of the best days or weeks in the market can have significant impact on your return. Market timing requires being right twice. First, you have to time when to get out of the market. And second, you have to time when to get back in. And both are equally difficult. Fifth, ignore the daily moves. We've shown just a few examples of daily events that move markets by record amounts. And most of us have no recollection of those specific days. But in the context of history, big daily events are often just blips on a screen long term. So investing, we can't get caught up too much in the day-to-day headlines or market moves. Now, Christina, I'd like to thank everyone for joining us today, and we hope we've addressed many of your concerns. We're living through historically turbulent times. Again, like we've shown, this has happened before. And at Saltmarsh, we're here to help you through all those times, the good times, the bad times, and even the scary times. So now, if we have a few questions, we have a few that have already been submitted, and we'll address those. But if you want a question, chat a question in to Nancy, we'll be happy to field those.
So it looks like we have one question so far. I'm just going to go ahead and read that to you guys. The Fed has announced multiple rate hikes. This person has noticed that the price of their bonds are down. Can you speak on this and what a bond investor should expect in a rising interest rate environment, and should they do anything?
Yeah, so if you look at your fixed income investments, the bond funds that we use with high quality bonds, they've got literally thousands of bonds in them. Now, when interest rates go up, the price of bonds go down. So you're going to see a short-term drop in those prices. But unlike stocks, you have to remember bonds have a maturity date. And most of what we recommend is short to medium-term bonds, which makes them less volatile. So yeah, the price is initially going to go down, but they're going to mature at par if they don't default, which we have high-quality stuff. But what happens when interest rates rise over time? If you're a bond investor, those bonds that mature get reinvested at higher interest rates. So over a long period of time, it actually can help the yield on your bond portfolio.
Yeah, and I'll comment and say, the bond market doesn't always get it right in the short term, but over the long term, it tends to self-correct itself. And so, as Mark said, with those maturing bonds, you're going to see as interest rates go up, the bonds get replaced with bonds that have a higher yield. Any other questions, Nancy?
So it looks like we have another one. When diversifying stocks by sector, what should be used for target allocation percentages?
So I'll start that one. It really comes down to an individual's time horizon and risk tolerance. We use that as the parameters to help determine that asset allocation. So that the most important thing, as we've indicated today, is your ability to stick with the plan. And so you've got to be able to sleep at night, and leveraging stocks and bonds in the appropriate amount to make sure that you're going to stick long-term with the plan is really critical. So age is not always the determining factor of how much risk. Yes, it is true that younger people have a longer time horizon, so typically will take more risk, but we certainly have many investors who are older because of circumstances. They don't need the money they have invested, or they're investing for the next generation, or they've accumulated significant wealth, and they're very comfortable with risk. They're willing to take on more risk. We also have some individuals who frankly just can't stomach the risk, and so You really have to balance that out. And so that is a topic of conversation that we really drill down into to make sure that we're helping that investor identify that appropriate risk for the long term. And then it may be appropriate over time where you back off that risk, especially as significant events happen within your life, whether you're retiring or you're in retirement, so you may back off your risk. Mark, any other comments on that?
Yeah, I was going to say, and even within a given portfolio, even within the equities portion, we have a certain allocation to U.S. stocks, foreign stocks, emerging market stocks, and a lot of times real estate. So even within your equity portfolio, we've got diversification across different sectors of the equity market, not just equities versus stocks.
Yes.
Okay, and we have another question. I can get my screen bigger, sorry. Why does the fluctuating price of crude affect the price of the refined product already in tanks under the service stations, which may have been refined from crude at a lower cost months earlier?
I used to work for a bank, and honestly, the little inside baseball knowledge I had, a lot of times gas stations will just raise the price in response to crude oil going up. You're exactly right. A lot of that oil has already been refined. So they do tend to adjust higher quicker than you would think. The other thing I will say that in addition to that, if you go to most gas stations, they make a little bit of money on gas. They make most of their money by selling Cokes and candy bars. So gas is just sort of the way to get you in the door. Then also, another thing that affects the price of gas, you've got different states have different taxes. That's probably the number one biggest difference. But it's also it's the transportation costs. How close do you live to a certain refinery, right? Because they've got to put it on a truck, a tanker, and take it from one place to another. But it does seem like they go up fast and come down slow. So that was the little inside baseball that I had from a previous job.
All right, we have another question. So any advice for those like this person who come in and say that they're 40 and they hate risk? Initial thoughts of what you would share if someone hates risks?
Yeah, I mean, I'll just start off real quick, Christina. There's a risk of being out of the market too. I mean, we saw that. Like, it's not just risk of it going down. There's an opportunity risk of it going up. And when you have inflation, sometimes the best thing to have in your portfolio is stock. So you've got a risk there too of just keeping your money in cash. And it kind of just depends on what your risk tolerance is, what's going to keep you up at night and what's not. Do you want to add anything to that, Christina?
Yeah, I would just say we completely understand. I mean, risk can be very uncomfortable when there's volatility. But as Mark said, the risk of not having growth in the portfolio can be extremely damaging. And so it really comes down to how much risk do you need to take? And we have tools and resources that can help determine that, depending upon many factors, how much an asset you've already accumulated, how long you plan to work, your earnings history, and your future earnings potential, inheritance, etc. Not everybody needs to take a lot of risk, but by using these tools, we can help you identify what's appropriate, because the last thing you want to have happen is that you run out of money before end of life expectancy. So working with an advisor that can help you identify what's the appropriate risk for you can frankly help kind of manage those concerns and those worries about risk.
Yeah, and I'll add one thing to that, and it kind of comes, in the current situation, it's, it seems like, oh, do I really want to put money in the market right now? And, you have people that, might have a lump sum that they could put in the market immediately. Now, academic research is going to show, and over a long period of time, you're better off just putting the money in, right, and just not worrying about trying to time the market. I think we demonstrated that timing is pretty futile. But for a lot of people, sort of taking that lump sum and dollar cost averaging it in over a given time horizon can psychologically help you keep your money invested, because it's just like Murphy's Law. You're like, oh, if I just put it all in the market now, it's going to go down tomorrow, and you feel like you messed up. Whereas if you just take a portion of it and just sort of regularly put it in the market, and the market does go down, you have, it psychologically helps you kind of understand that and keep, you're getting investments at a lower average cost. And so that would be one comment.
Strategy tactic for some people.
A follow-up question to that. Where are millennials with risk these days? Are we even seeing millennials in the market?
Oh, millennials?
Yeah, like us younger people.
I don't know any demographic. I mean, I couldn't quote any demographics of how much millennials are in or not out of the, I hear a lot of millennials have student debt to deal with too. And we, that's part of what we do as financial planners is kind of take that whole big picture into account. But I would recommend many millennials, start investing and saving their money. What do you think, Christina?
Yeah, I will speak to a few stats on that. So millennials, because of coming out of the financial crisis, to your point, debt, trying to get into the housing market, have been slower than past generations in investing and saving for their retirement. They also, many of them tend to be a little bit more risk adverse to traditional diversified investing. So we would encourage that this is something that should be looked at and considered, and start to put a plan in place. Start to make sure that you are in fact investing and saving enough. In the first place is if your company offers a retirement plan, a 401k plan, you should absolutely be contributing there at least up to what your company matches. And then beyond that, your goal should be to max out your contributions to your retirement plan. And again, be diversified and take risk. Take the risk that's appropriate for you, because the most important thing is you got to be able to stick with the plan.
That's a good input. We have time for one more question. So you mentioned rebalancing stocks and bonds during the presentation. What is this and how does it help my portfolio?
Mark, you want to take that?
Yeah, so let's just say you have sort of a typical portfolio of 60% stocks and 40% bonds. And let's say the good news is the value of those stocks has gone up. And so the percentage that is allocated to equities or stocks goes from 60% to 70%. So now you've got 70% stocks and 30% bonds. What we typically do when we rebalance is we sell those stocks and reinvest in bonds to get it back to a 60-40 ratio. And so this it kind of helps you capture gains on the way up, and sort of keep at your 60-40 target. But at the same time, when stocks go down, right? If the stock market's down and your 60-40 portfolio becomes 50-50 or 55% stocks or 45% bonds, because the value of those equity securities have gone down. In that situation, we can take advantage of lower prices in the stock market by selling some of your bonds and reinvesting at the stock market in a lower rate environment or a lower price environment. And so over a long period of time, that tends to keep you on your target so that your risk profile is kind of commensurate with what you originally wanted to have invested in. So
yeah, it's a natural way to sell high, buy low. That's what rebalancing is all about. But it's a very disciplined approach, and it's important that either working with an advisor or if you're managing your own portfolio or your 401k, that once a year you're taking a look and seeing if you're outside the boundaries of your target asset allocation.
Very nice. We are running out of time a little bit, but if we didn't get to your question, Mark and Christina will follow up with you guys individually. But thank you all for submitting your questions. They're all really good. But thank you, Mark and Chris, for joining us today. Your webinar was very insightful. As mentioned before, your webinar recording will be available in your email tomorrow. Look for that. It might get stuck in your spam or junk folder, so double check there. If not, you guys can contact me and I'll send you guys a link right away. And remember, after our webinar, when we end, you'll be prompted to complete a very short survey. We would love to hear all your feedback. If you have any more questions for us, submit them in there for us. And we hope you guys have a great rest of your day. Mark, Christina, do you have anything else to add?
Oh, thank you very much.
Thank you. Talk to y'all soon. Thanks.
All right. Bye. Thank you guys for joining.